Welcome to the first episode here of Find My Way Home Live, where we're going to get together every Thursday, go through important topics that home buyers, homeowners, questions that they're asking and that we're seeing on the site and in our network. Joining me tonight is Mia Schultz, and I'm going to add here David Zai into the stream here. So wanted to give you guys a background in case you just stumble on the channel or stumble onto this live stream of what Find My Way Home is and how we got here. Way back in 2007, 2008, when the market kind of went nuts and went sideways, my business partner, Scott Shang, founded Find My Way Home, basically taught himself WordPress and started blogging about issues and problems and troubles that homeowners were having and experiencing when it came to mortgage and their real estate. So through that time, throughout the years, certain articles got traction. We started getting a lot of input and feedback, people calling and asking questions and wanting to get connected with expert loan officers throughout the country. And through that time, we've built up a network of folks that we can connect people with who can answer their questions. So what Find My Way Home became is basically a network of expert mortgage loan officers throughout the country who can handle things that are a little outside the box, that your normal call center loan officer can't handle, and can often get you better terms than what a big box retail lender can handle. So with that, the context for tonight's show and future shows is that we're, again, going to pick a topic and we're going to have a couple of the experts from the network on, and we're just going to go through it. We're definitely going to take questions, question and answers. I don't know. This is our first time doing it. We've promoted it a little bit, but not too much. So who knows if we'll end up with any questions, but we're going to go through that discussion. So like I said, I've got Mia Schultz with me here in Chicago. Mia, why don't you just give us a little brief introduction to yourself and how you got in the mortgage business and how you came to be a member, one of our first members of the Find My Way Home Expert Network.
Hi, Josh. I'm so excited to be here. I didn't realize this was number one. So
number one.
Super excited. Find My Way Home has been growing and growing, just like you said. And I met up with Scott in 2013 because I had a client that had an issue and I was Googling for answers and stumbled upon Scott's blog, just like everybody else. And we hit it off, realized there was a need out there for people like us who want to take on these maybe more challenging or maybe just knowing the guidelines better than the next guy. And have just been rolling with Find My Way Home since then. I work with Geneva Financial and I've been in the loan business since 2007, right in the crash.
And that was a great time to get started, right?
Everybody looked at me like I was crazy for getting in, but it ended up to be the best thing ever. While everybody else was losing business, I had no place else to go but up. So it was nice to be in that kind of frame of mind, learning and getting to know the business while things were kind of shaky, because it opened a lot of doors, actually.
Perfect.
So, very good.
In addition to being able to help people in Illinois, your home state there, what other states are you able to help folks?
I am licensed now in 19 states. So I've got pretty many out there, but we could list them all below later on.
Perfect. And my other guest here tonight is David Zai. David is an originator and a branch owner in Virginia. David, why don't you tell us a little bit about where you're located there in Virginia, and how you got in the business and how you came to be a member of the Find My Way Home Expert Network?
So, yeah, thanks, Josh. So I've been doing mortgages for 18 years out of Virginia Beach, Virginia, and I met you and Scott Shang at a coaching group that we coach that we get coached at together, the Freedom Club, and I saw Scott give a presentation, and it was such a great presentation. He talked about how there's so many opportunities out there to help people that have been told no, wrongfully no. And, that's one of those things that, totally touched me. And I said, you know what, I've got to figure out a way to join this network and make a difference. So my branch, we could do loans in all 50 states. And it's truly been an honor to help out everyone, that needs the help. And I mean, I'll tell you, it's a great network of great professionals, and I'm honored to be a part of it.
Perfect. So kind of bringing it full circle, everyone kind of ended up here on this call through Find My Way Home. I met Scott through Find My Way Home. We became business partners in our mortgage company, Bywise Mortgage here. Unlike the two of you, we stick to the giant Republic of California and don't leave and go out to the other 49 states, at least not yet. But Scott and I met basically through a similar spirit. I started doing loans in 1995 in a market that was really difficult. A lot of first-time buyers, FHA loans with 5-6 borrowers on a file, and we learned how to make the hard stuff come together. So Scott and I found Scott through Find My Way Home, saw him speaking at a live event here. He and I became friends and realized we were on parallel paths and said, hey, maybe we should just partner up. So we ended up being partners both in Find My Way Home and in Bywise, our mortgage company here in California, where we're able to help folks. So that's enough about the three of us. You know who we are and what we do and how we got here and a little bit about Find My Way Home. Let's jump into what we're going to be talking about tonight. And really, that's cash out refinancing. It's a big topic. If you look, unless you've lived under a rock, we were already experiencing pretty rapid appreciation up until COVID. And after a little pause, the housing market just went nuts. So anyone that's owned for a period of time is sitting on 35-40% equity. If you look nationwide, the average equity for a homeowner or the average loan to value is like 47%. So more than 50% equity in homes with mortgages on average. Now that's not everyone, but that's a lot of people. So it has a lot of folks saying, hey, I'm behind on my retirement savings, or I have some other debt I need to pay off, or I need to send the kids to college. How do I get cash out of my home to pay for these other expenses or to reallocate some of that equity? So Mia, why don't you start us off by just telling us a little bit about what a cash out refinance is and what it can do for you.
So cash out refinances have become, a truly valuable thing in somebody's life, because when they invest in their home, that's their biggest investment, right? And life goes on, and you are paying down this debt and hoping to, by the time you retire, have this all paid off. Well, during your lifetime, expenses happen, weddings happen, bills accumulate, and you've got all this money sunk into your house. Well, that's equity and that's your money. And if you need that to live on, that cash out refinance is your saving grace, because for a really low interest rate, even at the rates where we are today, you can take out that big chunk of money to help you cash flow your life, whether it's a big expense coming up or just to get things back in order from debt accumulation. And so a cash out refinance is really just taking the money that you've invested into your house, along with the accumulation of appreciation, and taking it out of the house, paying it back in the long term.
So you're paying off the current financing. So let's just take an example. Again, we're talking about differences with where you are in Illinois and other parts of the country, and us here in California and David in Virginia. Those numbers are going to vary. But let's say you have a home that you might have bought 10 years ago for $200,000. It's gone up to $400,000 in that time frame, and you've paid your mortgage down. You might owe $150,000. There's $250,000 of equity there. To get that, we have a few options. The cash out refinance is essentially, we're going to pay off that $150,000 loan with a new larger loan, and the difference there comes back to you. David,
Right.
with a cash out refinance, what can a borrower do with that money? Are there any limitations in terms of, say, in this example, someone takes a new $250,000 loan, they have roughly $100,000. What can they do with that, and is there anything they're not allowed to do with it?
That's a great question, Josh. So what my borrowers have been doing recently, and I just did a video on this today on this topic right here, is they've been taking it and just consolidating debt. I mean, with the uncertain future, and the rates going up, even at the current rate levels, they've been able to take it out, let's say at 5%, 5.5%. And paying off 18, 19% credit card bills, maybe even, paying off, a small balance on a vehicle loan and saving a couple $100 a month, with and some borrowers are taking that and investing it in other properties, other investment properties, and generating cash flow and just building equity on 2 or 3 additional properties at the same time. In terms of, what I wouldn't do with it, I mean, I probably wouldn't, buy anything that's going to depreciate in value. I don't even know what you could buy with it that's going to depreciate in value nowadays. I mean, with everything going up the way that it is. Cash out is a great option. That's really how I got into the industry was, just showing people, I worked at a company that all they did was specialize in refinances, and we met with customers face to face, and to see customers get that cash out at way higher rates than we have right now, and to save a couple hundreds of thousands of dollars. I mean, that really made a difference in the family's lives.
Absolutely. So we talked about a couple of different things. The obvious and easiest one is to pay off higher interest rate debt. Whether it's credit cards, it can be auto loans. We got to be careful because an auto loan usually has 3, 4, 5, 6 years left remaining on it, and now we're stretching that out over 30 years. But that's a great strategy. And one of the things that we can do in some of these examples, we have a client we're doing a refinance for. It wasn't even that much money of credit card debt. I think we're talking less than $50,000 of credit card debt we're paying off, but it was $1,900 of monthly payments. So when you look at that, she is increasing her interest rate about 0.5%, but we were able to shorten the term and still massively lower the monthly payment. So those are some of the strategies that your loan officer should be looking at with you. But above and beyond just the cash out for paying off and consolidating debt, we talked about investment purposes. There's no real limitations to what you can invest in. The lender's going to let you take that cash out. You can put it in the stock market. I have a client, you guys will find this interesting. I had a client a few months ago. Our loan amounts and home values are a little higher here in Southern California. $1.7 million appraisal. He owed about $700,000. He took $400,000 out to buy crypto about the same time that crypto had a little bit of a correction, but he's got the long view on it. He's going to pay for his retirement. He's going to pay that mortgage off when his crypto doubles or triples. So you can invest in crypto, you can invest in stocks, you can invest in bonds, you can invest in a business. I have some clients here recently that wanted to buy a building for their business. They owe $300,000 on a $2 million property. Pull some money out to buy a business property. So investments. And Mia, you had talked about you can pay for a wedding. You can pay for a kid's education. You can pay for your own education. Any number of things that you can do with that. Any stories or recent success stories you guys have of a client that has taken cash out and what they've done with the funds? I know, David, you had told us about a few investing in properties. Anything that you have here recently, Mia?
I have most of my clients recently have been refinancing just to consolidate debt. And that's just such a satisfaction when you put those deals together the same way, where they're dealing with $1,000 in monthly payments, and we could refinance their home equity, their home loan, and bring them down and save them maybe $800 a month, which is just crazy. And that could just save somebody from just digging themselves deeper into a hole. People just need that little breather and to stretch it out and cash flow their monthly payments. So it's pretty exciting. I had another person who was also doing a cash out refinance that they were just getting their feet. It was a young couple just getting their feet wet in the world and wanted to invest some of their equity. And just like you had said, they're going out, they took out a cash out refinance. They're going to pay 5% on that new loan, and they're probably going to be making 10, 12% on their investments. So it pays for itself. In those kind of situations, it's really paying for itself.
Absolutely.
Yeah.
So in the context of that, obviously, not everyone qualifies for a cash out refinance. David, do you want to talk us through the parameters of maybe the different types? Why don't we do this? David, you start and walk us through what are your options with a conventional, meaning under Fannie Mae and Freddie Mac guidelines, conventional cash out, and then Mia, maybe you can tell us how that differs for, say, an FHA or a VA loan, which both of those are very different from one another. But David, how about a conventional loan?
Yeah, conventional cash out is typically, I I guess it really depends on whether it's a single family residence, a duplex, multi-unit. I think the pricing, obviously, the higher the loan to value, and what loan to value is your loan versus the value of your home. The higher the loan to value, the more pricing adjusters there are, and there aren't as many adjusters, which Mia will kind of get into with the government cash out refinances. So we evaluate a couple different things. We're looking at the credit score, and on a conventional refinance, that's going to have a bigger adjustment on credit score, the loan to value, the debt to income ratio. So I think for the consumers that are watching this right now, one of the most important things is to really like dive deep with your loan officer, and just totally understand where the adjustments happen, and whether it makes sense to refinance. And sometimes, let's say the debt to income ratio is a little high. Maybe we can pay off a little bit of debt to get the debt to income ratio maybe under a 45% debt to income ratio. Or if it makes more sense to get 75% instead of 80% because of the pricing adjusters, that may be something that they want to consider, especially with the values coming in or being much higher now. We're able to offer 75% loan to value, and your customers are still able to get more cash out. So there's a lot of different factors, loan level pricing adjustments and things like that we look at, that need to be considered when doing a cash out refinance. And I would just make sure we're looking at that appraised value, and not having different like sites like Realtor.com or Zillow influence us in thinking that the value is going to come in at those numbers. Because if there's one thing that I've learned in this industry, those numbers are typically off by anywhere between 5 to 20% in value. I recently did a refinance for a borrower that had cash out refinance, and we were expecting the house to come in at $350. Surprisingly, it came in at $400,000, which was great for him. So we were able to drop that loan to value 10%, and he still got the amount of cash out that he wanted for his investment.
So David, hold on to that thought on the appraised value. I kind of want to circle back and just make sure for the folks watching at home, some minimum and maximum figures. So let's say you're looking at a conventional loan. You don't want an FHA loan, which will have mortgage insurance. You're not eligible for a VA. So you're looking for a Fannie Mae, Freddie Mac loan. What is the minimum credit score required to be eligible for a cash out loan? It doesn't guarantee that you would get it, but what's the minimum to be eligible?
620 on a conventional loan. As you guys know, it's pretty challenging at a 620. I would say once you get to about 645, if there's enough equity, I think we could really get it through at a 640. But 620 is the minimum.
And when you say it's tough at the low 620 scores, it's tough in two regards, right? It can be more difficult to get an approval, an automated approval, and get the loan just through, period. But then you had talked about loan level price adjustments. So the terms, people, I'm sure you guys get this question all the time. Well, what is the rate? And well, I can't tell you what the rate is because there's not a rate. There's a rate for every loan. So what you're talking about is these loan level price adjustments. The best terms are at 60% or below loan to value on a conventional loan. And at different tiers as we go up, 70 is important, 75 is important, 80 is important. What's the maximum loan to value? What's the maximum percentage of your home's value that you can take out on a conventional loan?
80%.
Okay. If it's a single family and owner occupied, you had mentioned some other scenarios. So for our conversation, most of the folks watching are talking about taking cash out of their condo or single family residence home. So 80%, you're going to need a minimum of a 620 credit score. And let's go back now and talk, and to both of you, it's really important when a client calls in and they say, hey, I want to do cash out, and depending on how much equity they have, like that example I gave, if someone owes $150 on a $400,000 house, the appraisal can come in $50,000 low, they're still going to be able to get a bunch of cash. A lot of our people are saying, I need to do this, that, or the other, and I need X number of dollars. So we need to know, are we under 80%? Are we going to get it under 70% to get the terms? So what, Mia, do you do specifically when a client says, hey, my house is worth $400,000, and you know that it's important that we hit somewhere in that number? What do you do to ascertain the value besides just the Zillow and Redfin, the stuff that's available to consumers?
I do. It depends on the client and the area that we're shopping in. But we do have some of our own AVMs that we use also to look at value. I try not to depend on the Zillows and the realtors. We will go, I'll talk to them about their purchase price, how long ago they purchased it, and kind of assume some value appreciation there as well. In our business, people look at the loan to value and the credit scores and all the limits that they read about online. And just like you were saying, David, it's about the balancing act that we have to do. And they don't realize that they can't get that cash out refinance with a 620 credit score and a 55 debt ratio just because it says that in the guidelines. We're all a balancing act, and it all goes through automated underwriting. And that I don't think a lot of people realize that we don't have that direct answer and can't give them that, yes, we're cool because you meet these minimum parameters. So with regards to the loan to value, the lower the loan to value, the better that balance is going to look if you have a lower credit score, and vice versa on the other side. So, when we're going into this, we don't want to waste anybody's time or money with appraisals and things if we really don't think that they've got a shot, because a lot of people, I think everybody, myself included, always think that our homes are, bigger price than they really are. And so we have to keep everything in check and go with the worst case scenario. And if we get more, then we can up that loan amount down the road.
Mia, you said something really important. We don't want to waste a client's money when the value is not there. And that's a different view of it versus an inexperienced loan officer who just doesn't know out of ignorance how to track down the value. But worse yet, some of the big call centers, they don't care. They are literally intentionally trying to get your credit card and order an appraisal as soon as possible because they figure you're committed. Once you've spent $400, $500, $600 on an appraisal, now you're committed to the process, and whatever it comes in at, they'll adjust the pricing, they'll adjust the loan amount, and you already have some money in the game. So that's why we talk about it's really, really important that if you're going to a higher loan to value, I'd say anything over 70%, we're starting getting into pricing issues. It's easy to be 5% off in a value in your estimate, especially if you're just using tools like Redfin and Zillow. So Mia mentioned proprietary AVMs. That's an automated valuation model. And it's a fancy word for exactly what Zillow and Redfin do. Those numbers are an AVM. And for the most part, they're pretty good. But what they don't do, if we pay for a proprietary AVM, it's going to do some different things. It's going to say the value is $422,000 with 97% confidence. You don't see that in a Zillow or a Redfin. It might come back and say 91% confidence or 60% if you're in a rural area without a lot of comps. And it's also going to give us a range of saying, hey, we say with 90% confidence it's 422. The range appears to be anywhere from 390 to 450. And by doing that extra step and doing that extra research, now we say, here's your best case. If the value comes in high, here's your worst case if it comes in low, and there's no surprises, and you go into it making educated decisions. So just a quick little recap on the conventional. Minimum is a 620 credit score. Maximum loan to value is 680. For the most part, with conventional loans, we don't have limitations on how much cash you can take out. It really comes down to, can we get an approval? And for the most part, most lenders will not do a manual underwrite on a conventional loan. So we have to get that through the automated underwriting system. So Mia, why don't you tell us a little bit about, I don't necessarily want to lump them together, but the government loans, FHA and VA, both used to be uniquely different than conventional. Now FHA is kind of similar, but tell us what FHA looks at in terms of what you can do cash out wise.
FHA has a lot more leniencies than a conventional loan. Conventionals are very sensitive when it comes to that balancing act that I talked about with credit score and loan to value and debt ratio. On the FHA side, we can have a much bigger debt ratio where, we can get more people approved, and we can also have a lower credit score where the underwriting system isn't going to be as sensitive to us putting those through. as a cash out. Cash out is another risk factor in itself because you're taking equity out of the house. So the system looks at that as well. We can still go to 80%, but you do have to 80% loan to value on an FHA loan, but you still do have to pay PMI because it is a government loan. So even though you're under that normal threshold of 80% on the conventional side where you wouldn't normally have to pay PMI, we do have to pay it on the FHA side. But if you can get that cash in your pocket, it's definitely worth looking at.
So in a perfect world, we really want to go conventional on a cash out refi because we can avoid that mortgage insurance.
Absolutely.
But we can have potentially more flexibility. So some folks, it's the only option. It truly is. I have a client that we closed about 2 months ago. She was referred to us in a really tough situation, and she had a 560 credit score. Now, I was actually stunned by this, that I'm thinking, okay, we meet the manual underwriting guidelines, and on an FHA loan, you can do, most lenders will do a manual underwrite, which means the automated underwriting system will not approve it. You can put it in front of a real human and they go through it and tell you whether it does qualify. And in this one, we ran it through with a 563 credit score. It was a 50% loan to value, and the DTI was reasonable. The debt to income ratio was pretty reasonable, and it gave us an approval. So with that, that was the only way she was getting the loan. So we can whine and cry all we want that it has mortgage insurance, even though it's a 50% loan to value. But for her, it was the only game in town. And so that FHA is super helpful in that regard. Now, David, that varies. Probably the most flexible option that we have left for those of you who have served in the military and served the United States and are eligible for a VA loan. Tell us about the flexibilities on a VA cash out refinance.
So VA is definitely right up my wheelhouse. Being in Virginia Beach and being on like pretty much right down the street from the largest military base on the East Coast definitely helps out a lot. But with the VA loans, most of our traditional lenders are going to go to 90% loan to value on the cash out. There's definitely some net tangible benefits that have to be met. And for what is a net tangible benefit, right? What is the benefit to the veteran? Are they cutting their term? Are they getting cash out to, consolidate debt or lower their monthly payments? So there's got to be a benefit. However, if there's a true benefit to refinancing, and there's a different like type 1 and type 2 cash out refinances now with the VA loans, with true net tangible benefits, certain lenders can go up to 100% loan to value. I did 100% cash out refinance probably about 2 months ago for a borrower. The rate had a little bit of a light loan level pricing adjustment, and it's going to be totally different from the conventional side that I just talked about. The loan level pricing adjustments are really minute on the government loans, whereas with a conventional refinance, it's like every one of my fingers. They may not interlock and form that perfect combination, so we don't know until we run it through the automated underwriting system. But just like the FHA, it does give you the ability to manually underwrite a loan. So that's definitely a huge benefit to the veterans to be able to do that. And typically those rates are going to be lower than your conventional loans. And the funding fee, unfortunately, that has to be paid. However, the benefit on the funding fee is that it gets rolled into the loan on this cash out refinance as well. So 90 to 100% is the high. If we're going down to like 60, 50%, there's not that much of a pricing improvement on that. So it's definitely provides a lot of flexibility, and thanks for your service if you qualify for a VA loan. Active duty, reservists, surviving spouses, they qualify for the cash out refinances.
And that the VA loan, when you say 100% cash out, that's legitimately about the only loan in the world that lets you go to 100% cash out anymore. For the most part, you had hinted at this, 90% and below is going to get you the best terms or better terms. If you need to go over 90 up to 100, you can absolutely do it. You're going to pay a little bit of a premium for it. So we've kind of talked about a number of things. We talked about what you can do with the cash. We've talked about what is required for you to get cash with both conventional FHA and VA loans. Why don't we talk a little bit? So we've kind of gone through what are the pros of getting cash out. You can invest in other things. You can maximize your cash flow by paying off some higher interest debt. You can invest and get a greater return somewhere else. What do you guys think or see? What are some of the downsides or potential downsides of taking cash out?
One of the things that you had touched on earlier, I love to do when I do the cash out refinances where I'm doing debt consolidation. Generally, people are coming to me, within that first 10 years of their mortgage. And it's an awesome feeling for them and for me if I can get them into a 15-year mortgage and pay off all of their debts. Because now, some people do have that concern that, okay, I'm going to take out this cash, throw another $50,000 on my house, and I'm going to spread it out for another 30 years. I'm never going to pay it off. But if we can consolidate, and instead of taking that break, like I referred to before, that $800 discount, let's say we paid off all your debt. And instead of taking that break, we put you into a 15-year loan and save you maybe $200 a month instead. You're going to pay it off that much quicker, save thousands and thousands of dollars. And we've just now killed two birds with one stone and put you in a much better position.
Yeah, no, I love being able to shorten term. Because we talk about, you go back, you came in 2007. What I can say is 2004, 2005, 2006. I was talking to one of my buddies who was also in the business at that time. And David, you said you go back 18 years, right? So you were in the business at that time. It was not uncommon to have clients that you did 2 and 3 cash out refinances in that 2 to 3 year time frame. People, it's sort of a cliche or a joke now. People were using their home as an ATM. Well, seriously, people were using their home as an ATM. So
I wasn't even in the business, but yes, that's what everybody did.
And for us here in Southern California, where everyone's trying to keep up appearances, I mean, it was nuts. You had people that were driving cars or out at the river with boats that you're like, you can't afford that. I know what you do for a living, but long way of saying we don't want to do that. So you want to strategically use the equity in your home and the growth that we've seen over the last 10 or 12 years. You don't want to just take it out. David made a really good point earlier. Don't buy depreciating assets. Don't buy that boat. So boats may have appreciated over the last 3 years since COVID. I don't think that's going to be a long-term trend where boats are going to be appreciating assets. So be very careful with what you're acquiring if you're taking on home equity debt to buy a property. David, any other cons or things that you can think of that people should be aware of when considering using their home equity?
I do want to bring up a point. I'm an avid boater. So
everyone should buy a boat regardless?
No.
Oh, okay.
I own 2 small boats now, but the big boats, I mean, you know what boat stands for, right? Bring on another 1,000. Yeah. So yeah, definitely not depreciating assets. Don't treat your house as a credit card. I mean, it hurts me when I see people that have done that. And then when they get to the age of retirement and they're like, I've got nothing. I've got I mean, this decision that you make when you do the cash out refinance is going to influence your next 5 years, 10 years, 15, 20 years, right? So, whatever you do, just really think about it from the long-term perspective. And I mean, it took me a long time to get to this point, now when I look around at all the things that I've acquired, I'm like, wow, that made me happy when I bought it. But now it's like, it's just a paperweight, right? So when it comes down to doing a cash out, and that's what I love about this crew here, we always try to do things for the right reason. And, I love that Mia brought up the whole point about, hey, let's shorten your term, right? If we could do a refinance, consolidate some debt, save you money, on a shorter term, or even make it even and all of your consumer debts paid for, I mean, that's a huge win for everybody, and that decision is going to affect, your family, future generations and everything. So whenever you're making a decision like this, that and it's going to affect the roof over your head, definitely, weigh out the pros and the cons, write it all out. What is the benefit of taking this cash out? Am I going to have enough cash reserves if I do buy that additional rental property? Am I prepared for the next crypto drop? Am I prepared for if the stock market drops 20% and I put it in there, am I prepared to hold it? Or am I the type of guy that has like really, really weak hands and, I'm holding bags and, buying it is easy. Selling it is hard. So definitely weigh all those things out when you're considering a cash out.
No, really good advice. And a big way that I like to wrap it up, the Find My Way Home Expert Network, we don't have a monopoly on knowledge or wisdom or experience, but whoever you're working with, make sure that they're truly an advisor and not a salesperson. You can kind of see the difference here of how an advisor approaches going through your options for getting cash out of your home and what you're possibly doing it versus someone that's a salesperson that says, oh, cool, you want cash out? How much? Here's how we can get it and how quickly we can get it in your hands. You want to have a strategic long-term approach to it. And probably most importantly, remember that we should be trying to accumulate home equity. Doesn't mean that we don't find good ways to utilize it to further our financial futures, but you want to do it strategically with a plan of arriving at retirement without having to pay a mortgage payment to have a roof over your head. So with that, we talked about their pros and cons of a cash out. How about this? Are there alternative ways of getting cash out of your home besides doing a cash out refinance? David, do you have any thoughts on that?
I mean, the easiest way is a home equity line or a line of credit. The one bad thing about that, just like when I got a home equity line of credit, I just couldn't keep track of it, right? It was just one of those debts that, when you're looking at your mortgage, when you're making payments on it, it's amortized. So every single month, hey, it's going to tick down a little bit. And the longer you pay on it, it ticks down a little faster. Whereas even a guy like me who's in the mortgage industry, I just never understood my home equity line. I was just like, wow, this is just cheap money. And every time I look at it, it's like, wow, I paid it down $1 or it's just so minute. So a guy like me, I prefer the cash out refinance. Alternative ways, I really can't think of any other alternative ways of getting cash out.
So really, it's any type of second mortgage, right? You can do a home equity line of credit, which you talked about, and you could also do a fixed rate second, but it's a second mortgage going behind your first mortgage. You were going to say something, Mia?
Yeah, I have a client that I'm working with right now, and they're looking to try and move across the country. And they have a lot of equity in their house. They don't want to be rushed to sell their home in order to buy the next home. So this is a good reason to use a home equity line, because in most cases, I agree with David. But this is going to be a short-term fix. They're going to take the equity out in a second loan so that they've got it sitting in the bank so that they can pay their earnest money, down payment, moving costs and everything, and then move themselves across the country, then sell their home, pay off both of the loans. So that would be a case where we wouldn't advise somebody to do a whole cash out refinance, depending on the length of time that's involved. There are risks involved with the home equity lines. With the home equity line of credit versus the fixed rate line, second loan, because the interest rates do fluctuate on there, on the second loan. If it's a short-term fix for a certain requirement that you need, then great. A home equity line of credit is wonderful. And then you get to keep your first rate on your first mortgage if that's a good rate.
And just to kind of follow up on that, we're in a unique position here in Southern California in general, in that bigger loan amounts. Because of the bigger loan amounts, people seem to be more aware of interest rates, and we're more likely to take advantage of the really low interest rates the last few years. So it's not uncommon for me to have a client call up and say, hey, we got a ton of equity in our house. We owe $400 at 2.875% on the 30-year fixed. Home's worth $1 million, and we need $75,000 to add on. So you go, okay, does going from 2.875 to 5% to get $75,000 against $400,000 owed? It doesn't make sense. So the things that David said, that home equity line of credit, a fixed rate. Second is going to have an even higher interest rate, but at least it's fixed. It may not be ideal, but in that situation, again, when we're laying out the numbers never lie. Work with an advisor who can pencil these out for you. And we can say a blended rate in that situation is probably better to take the second. Seconds are just as much work as a first mortgage. They're not very profitable, so a lot of lenders don't do them. So you're gonna have a harder time finding someone to get to do it, but it may absolutely be the right answer for you. So a couple things that I like to point out in there is it's that blended rate. So the more you're wanting to take out, the more it makes sense to get a new first loan. And when I say the more, I don't mean more dollars. I mean more relative to the first. If you're taking out 50% of the value of your first mortgage, you're probably in a situation where you're looking at wanting to just put that into a new fixed rate. And something to be aware of, because we do have a lot of people that they're super attached to their super low fixed rate on their first mortgage, but they want cash out. We're looking at the Federal Reserve is in an aggressive rate hiking cycle, but they're at the very, very beginning of it. The last meeting, they raised 0.25%. Markets are expecting 1.4% more of rate increases at the next 3 Fed meetings. So probably a half, and then they're betting that it'll be likely more than a quarter, but not quite a half. So it's just the way the wagering in the futures market works out. But by the end of the year, we're looking at a 2% higher rate. So the Fed doesn't directly impact mortgage rates. They absolutely directly impact home equity lines of credit. So if we say today you're going to get a home equity line of credit at 5%, by the end of the year, that rate's now at 7%. So we have to look and say, where is everything going with where inflation is at and where mortgage rates are at, and how likely is it to stay that high, and what is your plan over the long term? So there's definitely options besides a new first mortgage of getting cash. But if you think that's the direction you want to go, you need to work with someone that can pencil out those options for you. So I think we've done a pretty good job of going through, the pros and cons, how to do it, what's required. Mia, did you have any finishing thoughts or anything we didn't cover that you think a homeowner should consider when taking to cash out of their home?
The biggest thing is every situation is unique and has several different directions that you can take. And like we mentioned, make sure that you're with an advisor who's going to take the time to walk you through what's going to happen 5 years or 10 years or 15 years down the road when you make this decision.
Perfect. How about you, David? Any other thoughts?
No, I think we covered a lot. I definitely wanted to touch on that blended rate. But you did a great job covering it. So you took the words right out of my mouth, and that's really hard to do.
That's what we try. I read David's mind, and then I speak for him wherever we go. So with that, I definitely want to thank both of you for being here for the inaugural episode of Find My Way Home Live. If you're finding this on YouTube, if you find it somewhere on the internet, find it on Facebook, and you've never been out to Find My Way Home, visit the website at findmywayhome.com. It's a library of articles, explanations, videos accumulated over the last 15 years that walk through every issue a home buyer and homeowner could have in relation to financing. And most importantly, we have the guide, the access to the profiles for all of the experts to find someone who can help you in your area if you don't already have an advisor that you're working with. So definitely check out Find My Way Home. Come back next week. I'm not 100% sure of what our topic is we're going to be covering, but we're going to pick something else that is of importance to homeowners and home buyers, and we'll go through it. So thank you for joining us, and we look forward to seeing you next week.
Thank you.
All right, thanks. Bye. Give us a thumbs up and like our channel.
Perfect, David. Thank you.